The latest 13F filings have sent ripples through the financial world, revealing some unexpected moves by top Wall Street hedge funds, including billionaire Bill Ackman's Pershing Square. These filings are a treasure trove of insights, offering a rare peek into the strategies of institutional investors managing portfolios of $100 million or more. For individual investors, particularly those who are new to the game, analyzing these quarterly reports can provide invaluable guidance and inspiration. When titans like Ackman make significant changes to their portfolios, it's worth paying close attention. In the most recent filing, Pershing Square made some noteworthy adjustments, reducing 4 key stock positions and adding new ones. What makes Ackman's moves particularly fascinating is that they involve major companies, some of which are part of the so-called Magnificent Seven, a group of leading innovators that have driven the market's upward momentum in recent years. Alongside these reductions, Ackman also made a few strategic new purchases, reflecting his thoughtful approach to navigating the current market landscape. This is exactly why 13F filings are so closely watched. They offer a window into where top managers see both potential risks and opportunities. One of the most eye-catching moves in Pershing Square's latest portfolio was the partial sale of Alphabet shares, one of the crown jewels of the Magnificent Seven. While this wasn't the largest sale by volume, it's significant because Alphabet has been one of Pershing Square's standout investments. Ackman first acquired Alphabet shares in early 2023, and since then, the stock has almost doubled in value, making it a star performer in his portfolio. So, why would Ackman trim his position in such a successful stock? The exact reasoning isn't clear, but it could be a classic case of profit-taking, where Ackman decided to lock in gains after Alphabet's impressive run. Alternatively, he might be concerned that the stocks within the Magnificent Seven are becoming overvalued, prompting him to reduce his stake as a precaution. Another possibility is that he's reallocating capital to take advantage of a new investment opportunity. Regardless of the reason, this move underscores Ackman's careful consideration of market conditions and his forward-looking strategy. In this video, we'll dive into 2 newly added stocks in Pershing Square's portfolio during the recent quarter. Together, these new positions have a combined market value of around $500 million. What makes this particularly interesting is that these are the first new stocks Ackman has added to the portfolio since Alphabet, over a year ago. This speaks volumes about Ackman's strategic selectivity, highlighting his focus on quality and long-term growth potential over mere diversification. Before we dive deeper into these stocks, if you're finding this content valuable, don't forget to hit that subscribe button. It helps us bring you more insightful videos, and you'll be the first to know when we upload new content. Let's start with Brookfield Corporation, ticker symbol BN. Bill Ackman recently added 6.8 million shares of Brookfield Corporation to his portfolio. These shares are valued at $321 million, making up 3% of his total holdings. Brookfield Corporation is a leading alternative asset manager, giving Ackman a diversified investment opportunity. However, Brookfield has faced challenges recently due to rising interest rates, which have impacted its real estate and infrastructure businesses. Despite these headwinds, Brookfield managed to increase its distributable earnings by 11% year-over-year in its most recent quarter, a sign of the company's resilience and its ability to weather tough economic conditions. Ackman is known for his strategy of investing in underperforming companies and then driving significant changes to unlock their value. A prime example of this is Canadian Pacific, where he successfully led a campaign to overhaul the board and management in 2012, leading to a turnaround for the company. However, Brookfield is not an underperforming company in need of a shakeup. With a robust market capitalization of over $15 billion, it's far from being a troubled asset. In fact, Brookfield reported distributable earnings of $2.1 billion in its second quarter, marking an impressive 80% increase compared to the same period last year. Ackman's investment in Brookfield comes at a time when he made headlines for canceling plans for an initial public offering. IPO, for Pershing Square USA, a fund intended to mirror his main Pershing Square fund. The IPO was originally targeted to raise $25 billion, but was scaled down to $2 billion due to low demand, before being withdrawn entirely just days before its scheduled debut on the New York Stock Exchange. This decision reflects Ackman's cautious approach in the current market environment and highlights his preference for investing in companies like Brookfield, which offer stability and growth potential during economic uncertainties. Next on the list is none other than Nike Inc., ticker symbol NKE. Ackman bought 3 million shares of Nike, valued at $39 million, which now makes up 2% of his portfolio. Nike's global brand recognition is nearly unmatched. Over the years, Nike has successfully positioned itself as a leader in the sports apparel and footwear industry through innovative products, strategic marketing, and celebrity endorsements. Brand equity is a critical asset, and Nike's is among the strongest in the world. This powerful brand presence has created a loyal customer base, allowing Nike to maintain its market leadership in the highly competitive sportswear industry. Nike's strong brand allows it to command premium pricing and maintain a dominant market position, making it an attractive investment for those looking for long-term growth potential. However, Nike has faced challenges recently that have raised questions about its future prospects. In the most recent fiscal year, which ended in May, Nike's revenue growth was a mere 0.3%, with sales in the fourth quarter falling by nearly 2%. For its first fiscal quarter of 2025, Nike forecasted a significant 10% drop in sales, with continued declines expected in the first half of the year. Several factors contribute to this gloomy forecast, including a weak wholesale order book, challenges in its digital business, difficulties in the Chinese market, and aggressive management of its classic footwear franchises. Despite these challenges, there are reasons to be optimistic about Nike's future. Setting low expectations and then exceeding them is a strategy companies often use to boost investor confidence. Nike's recent involvement in the Paris Summer Olympics is a case in point. The company used the global stage to showcase new products and invested heavily in marketing around the event. These efforts appear to have paid off, with web analytics company SimilarWeb reporting a surge in visits and sales on Nike's website during the Olympics. Another factor that might have attracted Ackman to Nike is its current valuation. Historically, Nike has traded at a premium due to its strong brand and consistent performance. However, the company's recent struggles have caused its valuation to drop significantly. Nike's price-to-earnings ratio now sits at under 22.5, considerably lower than the over 30 times earnings it has typically commanded in recent years. For a company with Nike's brand equity and long track record of success, this lower valuation could represent a buying opportunity for long-term investors who believe in the company's ability to overcome its current challenges. In conclusion, Bill Ackman's recent portfolio adjustments, as revealed in the latest 13F filing, highlight his strategic judgment in navigating the current market landscape. By reducing his positions in major companies like Alphabet and adding new investments in Brookfield Corporation and Nike, Ackman has demonstrated a careful balance between capitalizing on gains and seizing new opportunities. His decision to trim his stake in Alphabet, despite its strong performance, suggests a potential concern over market valuations or a desire to reallocate resources into other ventures. Meanwhile, though not massive in scale, the addition of Brookfield and Nike reflects Ackman's confidence in their long-term growth potential. Brookfield offers diversification and resilience during economic challenges, while Nike's iconic brand and recent undervaluation present a compelling buy for long-term investors. Ackman's moves offer valuable insights for investors looking to understand where top hedge fund managers see potential in the current market environment. If you found this analysis helpful, be sure to give this video a thumbs up and subscribe to Economic Hero for more insights like these. Your support helps us continue to provide quality content. Thanks for watching, and we'll see you in the next video.